Most people think banks exist to keep their money safe. That's the story. But if you look closely, banks don't actually work for you. They work around you, not in your interest. And once you understand that, a strange question appears. What if the problem isn't bad banks, but the idea of banks itself? Because hiding in plain sight is a quieter financial system, older, smaller, and designed to do something most big banks were never designed to do. Put the customer first. They're called credit unions, and whether they're better than big banks depends on a detail most people never notice. Let's start with why this question suddenly matters. Over the last decade, banking has become expensive. Monthly maintenance fees, overdraft fees that trigger in seconds, interest rates that rise fast when you owe money and crawl when you save it. At the same time, banks are reporting record profits. That tension isn't random. It's structural because big banks are not neutral vaults. They are corporations with shareholders, and shareholders want growth. Every quarter, forever. So when you walk into a major bank, you are not the client. You are the product. Your deposits become their fuel. Your fees become their margins. Your loans become their leverage. Now compare that to a credit union. Credit unions don't have shareholders. They have members. That sounds like marketing language. It's not. It changes everything. When you open an account at a credit union, you technically become a part owner. One person, one vote, no matter how much money you have. Which means the goal shifts. Instead of maximizing profit for outsiders, the goal is to provide better terms for insiders. Lower fees, better interest rates, simpler rules, at least in theory, and theory is where most comparisons stop. So let's move past that and look at how the system actually works. When you deposit money in a big bank, that money doesn't sit there. It gets lent out. Again and again and again. This is fractional reserve banking, where banks lend out most of what you deposit. Perfectly legal, highly profitable. For every dollar you deposit, a bank can lend out multiple dollars. That's how banks grow, and it's also how risk builds quietly in the background. Credit unions do the same thing, but with a constraint big banks don't have: scale. Credit unions are smaller by design. They don't operate complex trading desks. They don't gamble on derivatives or complex financial bets. They don't chase international expansion. Their lending is local. Your savings fund someone else's car loan, or mortgage, or small business. That creates stability, but it also creates limits. And this is where the story becomes less comfortable, because credit unions aren't a perfect solution. They trade scale and speed for safety. Big banks can move faster, offer slicker apps, provide global access. Credit unions often can't. And that matters more than people admit. Still, let's talk numbers. On average, credit unions offer lower interest rates on loans. Auto loans, personal loans, even mortgages. They also tend to pay higher interest on savings. Not dramatically higher, but consistently higher. The difference comes from where the profit goes. At a bank, profits go up to shareholders. At a credit union, profits circle back to members through rate cuts, fee reductions, occasional dividends, quiet benefits. Not flashy ones. But there's a reason banks spend billions on branding and credit unions don't. Because banking relies heavily on trust, and trust is fragile. And trust is hard to maintain when the math is working against the customer. Take overdraft fees. A few decades ago, they were rare. Today, they're a core revenue stream. Some banks make billions each year from customers being short a few dollars for a few hours. Credit unions charge overdraft fees too, but they're usually lower and often easier to waive. Why? Because punishing members doesn't grow the institution long term. This is the hidden mechanism: incentives. Big banks are rewarded for extracting more value per customer. Credit unions are rewarded for keeping members long term. One system thrives on friction. The other tries to reduce it. But now comes the uncomfortable part. Credit unions are not universally better. They are selective. Most require eligibility. You may need to live in a certain area, work in a specific industry, belong to a group. That keeps them focused and protected. But it also limits access and sometimes innovation. Big banks move slowly because they're massive. Credit unions move slowly because they're cautious. Both have blind spots. There's also a risk people rarely talk about. Credit unions are smaller, which means they have less room for error. One bad lending cycle can hurt. They're insured. Your deposits are protected, but service quality can decline. Branches can close. Technology upgrades can lag. So the choice isn't moral. It's strategic. If you want convenience, global reach, and cutting-edge tools, big banks win. If you want better rates, fewer fees, and a system that doesn't actively work against you, credit unions usually win. But here's the bigger implication. Most people don't choose banks. Banks choose them. Through employer payrolls, through mortgages, through inertia. And once you're in, switching feels expensive. Confusing, not worth it. That's how big banks maintain dominance. Not through superiority, through friction. Credit unions survive by offering a quieter alternative. They don't disrupt, they persist. Which raises a final question. If credit unions are often better for individuals, why don't they dominate? Because finance doesn't reward what's better. It rewards what scales. And the system we live in is optimized for size, speed, and profit, not fairness. So maybe the real question isn't whether credit unions are better than big banks. It's this. In a system built for growth at all costs, is better even allowed to win?